welcome to our very first webinar. Now, this is, since we only have a few folks, feel free to, we're gonna make this super interactive, and we are going to talk about funds. I am going to start recording. I think it's already recording, so that's great. Hi, Vassie. Hi, Chris. Great to see you, folks. This is great. Cool. All right. Excellent. So I see folks having their videos up. This is great. Cool. I think a lot of you are GPs or emerging GPs, and today we are going to talk about funds. I tend to make the topics super technical, and so, but I will leave the last like 10-15 minutes to just answer any questions. So AMA, okay? All right, so let me share my screen. There are a couple of things I want to go over, and then we'll get going, okay? All right, and then all of these recordings, we'll probably make them into YouTube videos and so on. Okay, so welcome everyone. And you can put your intro in the chat there, and then we'll get going. I'll put your contact information and so on. I see some familiar faces. And today we're going to talk about funds. I know a lot of you are doing syndications now, but if you want to go do funds, what are things that you should watch out for? First, an introduction of our webinar series. So we're gonna do them once a week, and here's the agenda item. And I am welcoming everyone to change the agenda item. If you have any topics, let me know, and then I'm gonna make this comment. So I'm gonna copy this down, and then I'm going to send it to folks here. Okay, send it to here. Okay, so if you have any topics that you want to talk about, let us know and we can do it. Now, to register, just know for next week, you have to pick the date and then you register. So like, for example, if you are interested in underwriting, that's September 11th, which is next Wednesday. It's always on a Wednesday. Then you have to come in here and then search for September 11th and then register. You see what I'm saying? So you have to do that. Yeah. Otherwise, you will not get the notification for that particular webinar. Now we do it this way because we don't. What happens if you try to sign out once and then it will stay on your calendar is that you just get bored. You're like, I don't know what this is, and so you're never gonna attend. But if we make it into registration based on each topic, then we have an idea of who are people most interested in. Okay, I hope that makes sense. Great. So that's that. Now, this talk is gonna be again very technical. So if you are doing something right now, you may not be able to follow along. So try to see how much you can follow. All right, cool. And I will maybe talk for another like 10-15 minutes, and then if you feel like this is too difficult of a topic, then you can just like ask me to slow down and make it easier. So we're gonna talk about funds and some of the topics within the funds. The funds there are usually four types of funds that we see most common. Closed-ended funds is 70% of the funds are closed-ended funds on Cash Portal anyway. And that includes special purpose vehicles, which is you raising money to do one thing and one thing only. Either you're raising money to invest into like 3 apartment buildings, or you're raising money to invest into 1 apartment building, but that's a closed-ended fund. Means it has a start date, you raise the money, you close it, and then that's it. There's no more investments come in later on. Okay. Open-ended funds is 15% of our funds that they do it. Basically, it's an evergreen fund. You keep it open for many, many years. And then within that, there's like tranche 1, tranche 2, tranche 3, and so on. Then there's the customizable funds. Customizable funds, only 5% of all the fund managers do customizable funds. And we can talk about that. There will be a whole separate topic on customizable funds. Then there is the income fund. The idea behind income funds is that they are raising money and they're paying their LPs some fixed return. Okay, they're paying their LPs some fixed return. Now, maybe you can put in the chat, or you can just like raise your hand because this is a meeting. You can actually speak. Which one of those funds are you folks most interested in, or most likely going to do on your next deal if you were to do a fund? Obviously, if you do a syndication, this is just a learning opportunity. But which one of them would you be most likely doing? A closed-ended fund. Perfect. That is the most common, and that is the way to go. That's correct. Yeah, I love it. Cool. Great. Excellent. So, okay, yeah. If you think of any answers, you can put it in the chat or just raise your hand if you want to speak. Okay. All right. Cool. So let's talk about closed-ended fund because the first three topics are about closed-ended fund, and then the last two topics are about open-ended funds, and it gets really complicated. All right. Let's talk about the first three topics. Keep it easy. So much of funds that's different from syndications is what do you do about the money that come in at a later time? Much of what we talk about is how do you create a mechanism to be fair? That's literally the essence of what's at stake. How do you create a fund structure that's fair for the people that come in later in time? Because you don't want people invest 100K with you. 2 years later, the people that come in later have the same equity, same structure, same price as the investors in 2 years ago. Like that's not fair. And so they devise a lot of mechanisms to keep it fair. And that's the essence. And that's literally everything we talk about is about fairness. Okay. But before that, there is one thing that earlier today we had a customer that wanted to do funds. And they asked, like, if I do a closed-ended fund that has that invests into 10 apartment buildings, now what do I reconcile each all these apartment buildings into a single K1 to my LPs? That's the question, right? Like you might have that. The answer might be very trivial, so I want to explain this again. So you can imagine you can replace this 10 apartment buildings with a 200 single families. You can replace it with 20 single families. Doesn't matter. It's like, how do you do it? Each apartment building has a T12, a profit and loss statement. Okay. So you got 10 of them. And each apartment building has a purchase date, which is when this building gets into effect, purchase date. Okay. So you have 10 T12s, and then you have 10, kind of like when each apartments is closed. And then you have the cap table. Cap table is basically all the investors' investments. Then last thing, you have all the distributions made to the investors. The CPA or and the bookkeeper is the one that takes all that information and create that unified K1. When it comes to money movement, the money moves like this. LPs, money moves into GPs. GPs take that money and need to spend that money. Fund managers spend it on buying apartment buildings or single families, or they spend it on purchasing businesses. This leg is CFP. This part is CFP. This part is not really the job of any investor portal. It's very clear. Like there's the money that you get, and then there's the money you spend. How you spend the money is the business. You are using it to buy apartment buildings. So this leg, all of this part, is the apartments P&L. That comes from your property management software. You have a P&L for each one of the 10 apartments. The CPA takes that P&L along with the cap table and the distributions, will reconcile them, create a single K1. Because they also need to care about when the investors come in, when the investors, their preferred return starts, and so on. So that's for the K1s. Your next question might be, well, if I have 10 apartment buildings, how do I know what to distribute? Well, that's easy. You have 10 apartment buildings. Each one of them makes some money. Each one of the 10 apartments has a different bank account. That's their operating account. Each one of them has some cash flow. Every 2 or 3 months, your CPA or your property management company will push the excess cash flow into your fund bank account. And you say your fund bank account starts with $1 million. 3 months later, it becomes $1.3 million. If you're comfortable distributing that 300,000, you literally just tell the software, say, I want to distribute $300,000, and then the software will figure out what is each LP owed based on the waterfall, right? So it's like that's the separation. That's how you think about the apartments, what the fund owns, and what the fund does. The fund is only distributing some money to the LPs, and from LP point of view, they don't really care about the apartments. They care about the fund's P&L. How do each apartment's P&L become the fund P&L? That's not really the job of an investor portal. That's the job of your CPA and accountant. I hope that distinction is very clear. All right. Okay. So that's useful. So that's the first thing. So all right. So that's done. Now, so much of our conversation then is on this lake. Okay, much of our conversation is on this lake, which is what's the relationship between the LPs and the GPs, and how do you build fairness into the system? All right, cool. So the first part about fairness is about preferred return. Okay, so topic 1, preferred return. Let's say your fund generates a 8% cash and cash, and then it's a 70-30 split afterwards. Okay, so LP and GP, this is the lake. So, but what if the people come in at different times? Let's say I have an investor A that comes in on January 1st, 2024, and investor B that comes in on January 25th, 2024. Preferred return should start differently for them. Now, that's up to your operating agreement, just to be clear. Now, there are a few options. Option 1 is you start on the close date of the fund. In this case, it will be, say, February 15th or March 1st. It doesn't matter what date, but it start on the close date of the fund. So this is like syndication. In a closed-ended fund, most people do this. So for the people that invest maybe January 1st, they technically their preferred returns doesn't start until February 15th, which is a month and a half later. It is what it is. It's fine. In syndications, also nobody cares, right? So yes, their money is not really usable for like that year, that month and a half, but it's what it is, what it is. So most people choose option 1 if you're doing a closed-ended fund. Okay. Some people may reward them for funding earlier, and so their preferred return starts on the funding date, which is if they wire the money on that date, your preferred return starts on that date. The third option is that whatever you do, it will start on the first of the following month. So if you fund on January 1st, actually too bad, your preferred return starts on February 1st. And if you fund on January 25th, also your preferred return starts on February 1st. You can imagine that you are in the mechanism design phase, and whatever you do, you lead to different incentives. If you always start on the first of the following month, you're gonna expect more investments come in at the end of the month. If you want to start your close date at the end of the fund, you might have this kind of incentive where they fund last minute. But most of the time, people just trust you enough. They give you the money just at their earliest convenience, because that 1 month difference does not make that much of a difference. Okay. Either way works. You just have to make sure that the software supports it, that you can put arbitrary preferred return start dates at the investor level, at the individual level. You can put it at the kind of the fund level, but you can also override that so that you can put it at the individual level. So that's the preferred return. Any questions, you can raise your hand. You can put it in the comments there. You can raise your hand and I can unmute you. You can speak on the preferred return. I'll give it like couple seconds. Otherwise, we can move on. Okay. Any questions? Okay. Yeah. Betsy, go ahead. Love it.
Gary, thank you. This is really helpful. So, just to back up a little bit where you talked about the CPA, although I think that will probably tie into the preferred return. So basically you're saying the portal will do the back office kind of, just for lack of a better word, reconciliation, and the CPA takes that and runs from there to create, whether that's K1s, monthly financials, whatever else is needed. Did I understand that correctly?
Yeah, that's maybe a more nuanced answer is that each apartment's building, that is the account, this is the bookkeeper, and this is the fund's bookkeeper, and CPA. Okay, this is provided by CFP. This is provided by CFP, but this leg, the one that I will use an underline. This underlined part is not really the job of the investor portal, because if you have a fund and that fund manages 10 buildings, that 10 buildings P&L, that reconciliation is not really handled by investor portal to reconcile. It's the bookkeeper or the CPA's own software that's reconciling them.
Got it. And the same would apply for a single building, right? If we have a fund for a single deal, that same concept would apply.
You don't. Yeah, exactly. You don't ask cash flow portal for like, hey, what's the P&L of my building?
Yeah.
You don't do that. You just ask the property management software. Yeah.
And in that case, we'll probably get it from, let's just say our fund invests in a syndication. We'll probably get the monthly financials from the syndicator.
Sure.
And then cash flow portal will figure out, okay, we invested, let's just say 2 million into that deal. Cash flow portal will then take that 2 million and parse it out for our individual investors in terms of, this is your share of the fund. This is how much you will get in terms of distributions this month.
That is correct. So the distributions on cash flow portal is from that $2 million fund to the individual LPs, right? And so $2 million fund, and then whatever the cash flow that $2 million fund generates, and that whatever cash flow that $2 million fund generates can either come from the buildings that you own or from the syndications that you are a LP on. Because being an LP, you will get the cash flow from that. And then, so that number is very clear. You don't even calculate, you just get the money. It's the actual, right? And then whatever excess that you're comfortable distributing, you give a top number, which is like, here's the number. And then the software will figure out what each individual LP will get, subject to their waterfall calculations.
Okay, perfect. Yeah, that was going to be my next question. Because for the prefs, then again, the portal will calculate this is how much is pref, and it's gonna track all of that for you.
Yes.
In terms of this is the pref, this is the promote, and this is where there is a shortfall that will accrue.
That's right. Exactly.
Okay.
Yeah. Pref, promote, and then the shortfall of the pref. So yes, that's right. So as you can imagine, sometimes you have to chew up the pref. So the software will remember how much pref has been paid, how much pref has been unpaid, and then if you give this number, it automatically calculates what percent of it is per the pref, what percent of it is the promote, and so on. Yeah.
Got it. And that's based on the information we input in the beginning when we set up the deal in cash flow portal, and that's something we input manually. Is that?
That's correct. It's a one-time input, and what it looks like is the following. So let's say I come in and let's say I have this is a closed-ended fund. I go to classes, I come in here. If I make this larger, you will see something like this fund is going to receive a 8% cash and cash, and then it's a 70-30 split until the LPs receive a 15% IRR, and then it's a 50-50 split. You tell it in almost this language, and then we will figure out, okay, that's your waterfall. We're going to run your distributions based on this waterfall. Yeah.
Got it. Thank you.
Yeah, very cool. All right, cool. That's great. Cool. All right, so that's on the that's on what the fund is, what's the preferred return. Okay, let's talk about when it gets more complicated. Okay, so topic 2 and topic 3. It's about distributions and income funds. Okay, so when some LPs, and this is specified in your operating account, let's say a LP invests $100,000 into a income fund, and the dividend is 12%. So each month they get 1%, right? So every month they should get 1%. $100,000 investment, 1% is $1,000. And so they have two choices. They can say, well, they have three choices. They can say, I want to get the $1,000 into my bank account. That's the most common choice. They get the distribution. The other choice, they can say, can you put that $1,000 back into my capital balance so that instead of $100,000 I have invested with you, I'm investing $1,000 now. Now your dividend of 12% needs to be act upon the $101,000 I have. So like their capital balance increases. It's like a savings account, right? Or they can say one of the $1,000, I want to distribute it such that I get 50% of it back, and then 50% gets reinvested back into your capital balance. You can imagine why this gets complicated and why you need a software to do that. And so that's something you want to watch out for. I will make a point though that normal closed-ended funds don't do reinvestment, don't allow the LPs to reinvest, but the income funds almost by definition want the LPs to reinvest back into so that so there's some. So very typical for income funds for them to reinvest back into the fund. Okay, so that's the second topic, which is fund. When you create a fund, be on the lookout of on your operating agreement. When you talk to your GP, talk to your legal counsel, ask, hey, should I have this ability for the LPs to reinvest their distributions? And there should be a clause on that operating agreement. Okay. Again, for non-income funds, that's not common. To give an example, syndications almost never talk about that stuff because you don't let them reinvest back, right? There's not much to do when you reinvest back. But for income funds, by definition, people want to treat it as a savings account, right? So that's the reinvestment of distributions. Now, topic 3 here is income funds. Now, here is another kind of like a nifty mind trick. So in a normal fund, like you invest into apartment buildings, distributions, the input into distribution is a single number, which is your excess cash flow. So like let's say your fund end up investing, cool. No problem. Thank you. Say you get about $100,000, and let's say $250,000 in cash flow. You basically will say, I want to give this 250,000 and then see what you can do with it. Like asking how would you distribute it to each one of the LPs on my fund? But the input is 250,000. In the income fund, you don't the input is not a single number. What is the input? The input is I want the software to calculate how much interest is owed to each LP. Like you don't give a number because you have no number to give. You just like everyone is getting paid 12% annually. And so if how many days have passed, so you pay them this interest. And so you need a interest calculator. So make sure that like just because someone does distributions doesn't mean they can calculate interest. So you want the software to be able to say, hey, I have a debt fund and I want to be able to calculate everyone's interest so I can pay out their interest for the month or pay out their interest for the quarter. And I also want to look out for if they want to reinvest that into their capital balance so that their capital balance is higher. That means they earn higher interest. All of that math needs to be calculated using a software. And so that's why when you have a fund, when you have an income fund, pay special attention to how that calculation is getting by. You don't want to calculate using spreadsheet, and especially you don't want to calculate when people want to reinvest into their capital balance. That should be automatically captured using a software. Right? So we talk about 3 things. We talk about income funds, we talk about reinvestment of distributions, and we also talk about preferred return. So those are the 3 topics that is for closed-ended fund. Any questions on those before we go on to something that is maybe even more advanced, which is what happens when you have a fund that has multiple tranches? Okay. Yeah, no questions? Okay, great. And yeah, questions you can message here or you can just raise your hand. All right, cool. Now, back to our first very topic, which is much of the funds is caring about when the investors are coming in and how do you develop fairness. And that is especially important if you are doing multiple tranches on your fund. Okay, so there is the topic 4, and then there's the topic 5. Let's talk about it. That's a little bit complex. So if you don't understand this part, no worries. Just know that there's a thing like that out there, and then you can come back to this video. So let's set up the scenario. Tranche 1. I'm creating an open-ended fund. I raised $1 million, and the close date of that first tranche is January 1st, 2024. Let's say that 1 million has $100,000 investment each, and you have 10 investors. So $1 million raised. Then 6 months later, I am looking to raise 1 more million, and the close date now is July 1st, 2024. Okay? So the essential question you want to ask is, how do you make sure that January 1st investor that invest the money 6 months ago, who put the money in first, get rewarded? Because otherwise it's not fair, right? So there are 2 options. Option 1 is the startup world. The startups use this option, which is reassess the value of that first million. And because that 1 million may have gone up in value, tranche 2 are buying into that new value. And in that world, there's almost a share price. And so usually the share price is $1,000 per share. And now the share price has increased to $1,100. And the tranche 2 investors will buy however many 1,100 per share shares there are. So if they have $100,000, they are not there's 100,000 divided by 1,100. So they end up buying like 950 shares. That's the startup world. That's not the typical world of real estate. Okay, I live in 2 worlds. I live in the startup world, and I live in the real estate world. Option 2 is the more common world, which is tranche 2 investors are paying tranche 1 investor some kind of true up. This is called an equalization payment. Okay, that's where the word equalization payment comes in. Now, your equalization payment will be defined in your operating agreement. It can be whatever you want it to be. Ideally, it needs to be 1 to 2 absolute percentage points lower than your preferred return rate. And it should be about 1 to 2 absolute percentage points higher than the current interest rate. But if someone who knows better than I do, correct me if I'm wrong here. But that's what we have heard. Okay. Why? Because you don't want it to be like super high. If it's super high, everyone will invest in the later stages, right? Because they just kind of keep waiting. It's like a free 8% preferred return. That's really nice, right? You don't want it to be actually the other way. If it's super high, then nobody want to invest in the future rounds because it's too high of a penalty to pay. If it's super low, then the initial investors are not happy because they can earn more using the Fed funds and the interest rate savings accounts and so on, right? So there needs to be a balance. Now, in the real estate world, option 2 is more common, okay, because it's easy to explain. So the equalization payment usually in today's age has an interest rate of 6%. So what does that mean? That means that tranche 2 investors have to pay the tranche 1 investors a total of 1 million. So they're going to invest 1 million and 6%, but multiplied by, because it's January 1st and July 1st. So 6 months pass. So it's like 6% basically divided by 2, 3%. So they have to pay $30,000 for that $1 million. And so if I'm investing 100,000, I'm not putting in 100,000. I'm putting in 103K. 100K is my investment. The 3K is the penalty I pay, such that I pay this fee so that the tranche 1 investors get true up. And so 100K is my cost base because you're buying into the fund later in time. Now, in exchange, you have the same ownership percentage now as the tranche 1 investors, which is nice, right? Because that's option 2. Option 1 is basically saying, well, I'm putting in 100,000, but I'm gonna get a less ownership percentage than my tranche 1 investors because I'm the price has not increased. Okay. Either way, but option 2 is more popular within the real estate world. Okay. That's what's called equalization payment. And so, as you can imagine, a software needs to have this ability that like I'm investing 100K, but I need this equalization payment. What is the percentage that you want to capture? So that if I'm investing 100K, I need to actually pay 103 or 104. It doesn't matter. That's a percentage you set. And then 4,000 or 3,000 of that is goes into paying the prior investors. How do you pay? You might say the individual investors don't really like pay to an individual. The individual investor, all this money will gather, and then it will be in the GP's bank account. And the GP will get $30,000 in total. And you know what? That 30,000, the GP will make a distribution to only the tranche 1 investors. Take this 30,000 and then split it among them. However, whatever their percentages, split among them. Beautiful. That's how that works. And then as a result, everyone's share price will be the same. It's a fascinating world. This is how multiple tranches work. Okay. Now, when you have multiple, let me pause there. Does that make sense? You can put in the comments. It's like, okay. Conceptually, that's fair. That's fair because you're paying an interest here in order to come in later, right? Cool. All right, cool. Now, let's talk about number 5 here. Okay. If you have multiple tranches, okay, you need to calculate a net asset value. I think a lot of you probably have heard of net asset value. And so I'm here to just explain what it is. Okay. Net asset value, the best way to understand it is the stock price of your fund. In the stock market, you have a share price, and that price keeps going up and down, up and down. NAV is basically the ticker, that stock price. And so it can also go up and down. Is that in the private equity world, in this alternative investing, it doesn't fluctuate a lot. It's almost like a quarterly report that NAV changes. NAV, net asset value, is calculated as the following. Is total assets minus total liabilities divided by the number of outstanding shares. That's why it's a stock price. It has this number of outstanding shares built into the equation. Okay, so that's that. So that's the formula. The numerator here is also called the net equity. You can imagine on an individual level, what I just highlighted here is called net worth. On a fund, it's called net equity. Okay, which is your total assets minus liabilities, net equity. That's that. Okay. So then net equity is equal to total assets minus total liabilities again. So then what is total assets? Total assets is the valuation of your underlying assets. Now, this is obviously arbitrary. Sometimes you hire a third party. Sometimes you just put a ballpark. Sometimes you do whatever. You look at your NOI, divide by the current market cap rate. You come out with your current valuation. This is fake, like fuzzy math. Nobody knows. The only way you're gonna sell, but if you're not selling, you don't really know what your valuation, but you can put a number on it. And then the other asset that you have is the money that's in your bank. That makes sense, right? So that's your assets. The bowl is the asset minus the liability. What are the liabilities? The liability is your loan balance. That's your liability. That makes sense. The other liability is any estimates for closing costs. Okay, so there's that. So let's give an example. So tranche 1 investor, it's a $1 million fund. It's $1,000 per share. Okay. And you have 1,000 shares. 1,000 times 1,000 is 1 million. Nice. What is the NAV at this point? Let's assume that you take that $1 million and you buy a $3 million building. Okay. And for whatever reason, there's nothing in your bank, which is a hypothetical example. You shouldn't do that. But, for easy math. So the loan balance now is $2 million. You have a $1 million down payment, $3 million price, and then $2 million of loan. And then you also assume that when you try to sell, your closing cost is 0 for simplicity's sake. Okay. Now, tranche 2 investors come in 6 months later. Now they also invest $1 million, right? And so you have a $2 million total now. And so it's still $1,000 per share. Okay, per share. And now you have 2,000 shares. Big, very nice. Okay. What's the NAV? You bought 2 buildings at this point, 1 building each. And so and assume that each building is worth $3 million. So you have a $6 million total on your buildings. Your loan is $4 million, and then your NAV is, you with a $2 million fund. So that all of that makes sense so far. Okay. So at that point, that is July 1st, 2024, because that's when you close second tranche, right? Because if I go up here, I said that the second tranche is on July 1st, 2024. Okay. So that was July 1st, 2024. Now let's fast forward a year later, July 1st, 2025. And your investors are calling you, hey, what is the value of my investment? Okay. The value is the NAV. Basically, their NAV is I invested, your fund was $1,000 per share. And what is the price per share now? What is the stock price of your fund? That is the closest thing to an intrinsic value of this fund you can get. And so this is how you calculate. Let's assume that your buildings are now worth 3.5 and 3 million. Maybe the second building you bought it for 3 million. Nothing has changed on that building. Okay, so it's still worth 3 million. Bad for you. But the first building has appreciated a little bit. It's now worth 3.5. Okay. So the net equity is the total assets is 6.5. And then plus the money in the bank, let's assume that's also zero for easy of calculation. The loan is still 4 million. Maybe it has reduced a little bit, but most of the time you're going to do interest only payment on commercial. So the loan is still 4 million, right? And then you have no closing costs also for simplicity. So your total net equity in the house, which is the net worth of your fund, is 2.5. Because there are 2,000 shares outstanding, that is $1,250 a share. So basically, the NAV is $1,250. So from the LP's point of view, they basically are looking at this. January 1st, 2024, my value is $1,000 per share. That's my NAV. July 1st, 2024 is still $1,000 per share. And then July 1st, 2025 is $1,250 per share. Just like a stock market. The NAV is the encapsulation of like their value. So like, okay, my investment has increased basically at this point, I think 25%. That makes sense, right? So that's what that looks like. And so NAV is the calculation. Now, this is the aha moment, right? Why is that between January 1st and July 1st, the share price doesn't change? It doesn't change because you have equalization plan. Because the second tranche investors pay some fee, pay some extra. They forget about it, and then the first tranche investors get that fee. So it's like, okay, handshake, we're equal now. We all go in at $1,000 per share. Okay, there's a underground exchange in the equalization plan because the later investors have to pay some kind of interest to the earlier. But with that interest, everything gets wiped out in the sense that the later investors can buy them for $1,000 per share. Again, that is the option 2 that we talk about, which is right here. Option 2 right here. Okay, the equalization plan. Again, this is more useful. This is more common in real estate. In the venture capital world, they are not buying it at $1,000 per share. What happens in the venture capital world is you buy it at 1,000, the startup has increased in value. Too bad you are buying it for $1,200 per share. So for the same money, you're gonna buy less shares of the company, which makes also perfect sense. But in that world, you can imagine that different tranches NAV will be very different because their starting point is different. Right? One person starts with $1,000 per share. There's the stock. And then imagine this is an Apple stock, but someone else actually bought it at a different cost basis. They're buying it for $1,100. And so even though at this point it's 1,250, everyone's gains will be different. Again, that's not the world of real estate. The real estate don't like that. They want everyone to have the same stock price in the beginning, and so they can really measure what's going on. Okay, I hope this is useful because that was the aha moment for me. So, this is what funds is. And so, yeah, so that's that. Okay, let me pause there. Maybe Chris, you're nodding your head. Paul, welcome. Yeah, any Any questions or comments there? I'll give everyone might be like 30 seconds to think. I know that was a lot. Yeah, Chris, go ahead. Yeah, love it.
Just it's more of just like a simple distinction. Can you just explain the difference between a fund and a syndication? Yeah.
Yeah, great question. So let's great question. One sentence description of the difference between a fund and a syndication. Okay. A fund, what's the best way? So syndication is for a single asset. Okay. A fund, you're raising a fund to invest into other funds or syndications. So the subject of the money is the property. That's in the syndication. The subject of the money is another fund or syndication.
Okay, that makes sense. I got it.
Yeah.
Okay, thank you. Yeah.
That's why I was saying. Yep. It's what you're using the money for. Got it. Okay, cool. All right. Awesome. Cool. Now, for those of you who came in late, so this is the document that we talk about future topics, and you can make comments on them. So for example, today we're going to talk about equalization payment and NAV, which what is a net asset value. Next week, also on Wednesday, 10 a.m. Pacific, we talk about underwriting, what makes up an underwriting. And Vasi here is an amazing underwriter. Following week, we're going to talk about CRM, like how do you integrate your front office and your back office. So like to give an example, this is Granite Towers. And let's say if I scroll down, this is their assets. And then there's this contact us, right? If I fill this out, it should go into a CRM. What it should not do, by the way, it should not just send you an email and not go to a CRM, because then you have to manually type it into your CRM, which is like really bad, right? Or if someone say, I want a free ebook, they fill this out, they get the free ebook, but you get their contact information that should be saved to their CRM. And so how do you combine your front office and your back office? And that's the power of a CRM. Paul, thank you for being here. Once we have the recording, we'll send an email out to everyone that attend, and I will also post on YouTube. And so here's the link, and then the recording will be posted here as well. And I will also send out the email. Okay, cool. Now, a few things. You can change the topic if you want. Okay, you can always tell us, hey, I don't like this topic. I actually want to. So email me with the topics that you want. This is our first meeting. And I hope that if we add value, the number of attendees will increase and over time. And as you can see here on this call, I actually don't really talk about Cash Flow Portal. I might say that we have these features. I might say these are important, but I should never really show like our software in a way, because it's more geared towards educating. It's like, okay, here are the things you should look out for when you're doing certain things. Okay, cool. And that will be the spirit going forward. Okay, there are certain times we'll show the software, but most of the time it's gonna just be education. I am in a very unique position because we talk to customers every day. I hear about what the GPs want. So I have a nice bird's eye view of what GPs care about, what things they struggle with, what things they are like really double checking with their attorneys. And I will say the equalization plan and also the NAV statement is something when you get into the nitty gritty, that is something they really care about. Okay. Right. And I also would like to make the 15 minutes in the end to just like AMA, ask me anything. So one of the webinars is actually going to be, ask me anything here. So you just come in and ask me. If you don't have any questions, then the webinar is over that day, like in 2 minutes. That's fine. Now, to register, again, this is already registered. Now, in order to register, you have to click on this link. Okay. And so you have to click on this drop down, and then you have to select September 11th, and then you register. So you look at this sheet and then find the ones you like and then register for that one. Okay. And we will also send out the email to the folks there. Okay. So let me take this link and then here. Okay. And then I'll send this one on the chat. So you can find the ones that you like. Okay. And then you can register for the future ones. Okay. So pick the ones you like. You can sign up for as many as you want, but we intentionally made it such that registration is required for future ones. Right, cool. So the last 15 minutes is ask me anything. And while you are registering, just you can raise your hand and ask any questions.
I can ask a question.
Yeah.
What made you come up with wanting to do this? Where was like the inspiration for wanting to do something like this?
Yeah, good question. So good question. I don't want to make it into a demo of Cashier Portal. That's not the intent. I want to educate. And I believe that a lot of the demos that we do with our customers, the first like 20 minutes is educating. They're like, I'm starting a fund. I don't know what a fund is. Tell me more about the fund. And so my time is worthwhile, even if 5 people show up, because I need to do the demo and the education anyway. And so if it's like I can do 1 hour of work that's equivalent to 5 hours of work, that's worth it for me. So it's more of a business calculation that I want to talk to the customers. I want to create this like collaborate and vibrant community, and my time is worth it. And in this case, we have like 7 or 8 people that show up. That's 8x of my time. And so I only have so much time, and this is a really good use of my time. And so that's the foremost. And when the GPs kind of see each other, they, first time is always like, I don't know what this is. I don't know if this I should continue. And by the attendees. But as time goes on, I think they're gonna become more natural. They're gonna raise their hand. They're gonna like, hey, come to the Wednesday meeting almost prepared. So, hey, I don't want to talk about this one, but at the end, can I just ask you these random questions? Yeah, great. Office hour. So that's that. That's the first reason. The second reason is I do believe that education is really important, and a lot of this is more like people don't tell you the answer. You have to ask the right questions in order to get the right answers. And so I synthesize them by talking to the customers, right? And like equalization plan, they just come to me of like equalization plan. I'm like, what the hell is this? And then why do you want this? And then they explain it. It's like, oh, that makes a lot of sense. So to teach that helps me stay current, because the audience can also correct me that I'm wrong. Like, hey, this is not actually true. And so that's that. And then the last one is all of these could become artifacts that we can put on our YouTube channel and so on. But it's adding value first. So that's why. So it's the most efficient way to add value. That's the answer. Cool. Yeah. Thank you, Paul, for to give a thumbs up there. All right. Any other questions? Great question.
Hi, Perry. Yeah, it's a great session. This is Ramu.
Yeah. Hi, Ramu.
I have a question related to cash flow portal.
Yeah.
So this is, we have syndication, not fund. So I heard like we have a we have the pref return. I heard like you are saying that one we have option to say that one pref returns can be after close and when you receive the funds. So that you are explaining in this session. So I want to that possible for the syndication, right? See, some of our syndications, we got the funds very early, but we couldn't able to close on time. So that they we want to give the reward to them, like whoever send them beforehand. So we want to start the distribution, then the fund close, property close, right? So that is 2 different ways actually. Some of the subscribers, they send that money 1 month, 1.5 months before than the after close.
Yeah.
So the short is here, the mixed, like some of the, people who send me, so we want to, give that distributions when they send the money, but some who send that one when they, before the close, we want to do, after close. So
Yeah.
is that possible in the cash flow? We can, mark some of these are the ones, hey, I want to give the pref return beforehand, and these are them, on after close, on or after close.
Yeah, bingo. So Chloe is here. Chloe is one of our senior account managers. And so you can chat a lot of that using this link, but I'll give you the first answer here. Okay. So
Yeah.
on each investment, and so I'm gonna make it into like this. So let's say I have this REIT LLC. When you click into the investment, scroll down, there is the preferred return start date. You can make it whatever you want. That's the power. And so Ramu, you essentially is a example of this topic one, which is like I'm saying that this is important. And so there you go. This is why you want it. And so you are literally the example of like, how do I have different preferred returns for the people that come in like 2 months after closing? Like, what the hell? And we're gonna pay them less preferred return, obviously. And so the answer for that is for those people, it is set here. But you can set it such that you can change it to be whatever you want there. Yeah.
Oh, okay. So we have the option to mark that one, each investor, what is their preferred return date is.
That's right. You don't have to bucket them. You just give them the ones that are different. It's default to the classes or the funds close date, but for the ones that you want to give special treatment, you can see here preferred return is the topic. The software is just a elegant solution to that topic, which is how do you give special preferred return dates to special investments. Yeah.
Okay, great.
Yeah.
Thank you.
That's right. Yeah. But if you like have more questions like, oh, this doesn't exactly work, then schedule a call and then we can walk through the more nuanced details if you want. Okay. But that should solve your problem. All right. Vasi, question. Yeah.
Hey Perry, thanks. And feel free to defer to offline if the question is out of scope. But could you walk us through the mechanics? Let's just say we decide to start a closed-end fund. What is the information you would need to get us started, and how does the pricing work for the closed-end funds?
Yeah, good question. So mechanics of starting a fund. Okay. Step one is knowledge. So like listen to podcasts and so on. I don't know any good book.
Oh, sorry. Just to be clear, not mechanics of starting, I guess, with cash flow portal. Let's just
I see.
Say, Perry, I'm ready. What information do you need from me to get things properly set up?
Yeah, got it. Okay, cool. Thank you for that clarification. The short answer is starting a fund on cash flow portal is as easy as starting a syndication. You literally create a deal. And so coming here, and then if I go to funds overview, click on here. If I do like say a customizable fund, which is a more difficult fund, then you will find an attorney. And so that's that. And then you do a deal setup. As you can see with the cash flow portal, it's literally just like adding a deal. It's the same as like any other deal. So it's like deal name, and then the deal type, you say fund, or you want to do a customizable fund, and then that's it. Those are the two options that you have. Okay. And so we automatically will know whether it's close-ended or open-ended. So it's just like setting up a regular deal on cash flow portal. There's not magic to it. Once you choose fund, there will be certain attributes that will show up as part of that deal. But if you do syndication, certain things won't show. And that's why how we differentiate between the two. But that's kind of working in the background. Then you find your CPA and so on and so forth, and you find your fund admin. So in terms of pricing, it's very easy. We are charging, you can do syndications and you can do funds. We only care about the funds under management. And so like if you're intending to raise say $5 million, it's 343. And if you're raising like say $10 million, it's about $500 a month. It works just like a syndication. And by the way, if you have syndication and you have fund, you can your EUM, equity under management, are combined. It's just total. So we are actually very inexpensive when it comes to the technology side. Now, there is the enterprise. And if you're doing fund, you might definitely check out the enterprise. The enterprise has the marketing CRM that's built in. That is usually like $49 to $69 a month. There is the underwriting that you can use for 5 users. And then there's the 12 hours of fund admin that we do administrative work on your behalf. This is labor. This is like we log into your Blue Sky filing and we file the Blue Sky on your behalf. That's the labor. That's otherwise we're gonna charge you $100. Actually, yeah, $100 per hour. But 12 hours, that is basically, $100 per hour. That's that. Okay. And so then there is the KYC and the AML, like anti-money laundering, that kind of checks. That's for very fund specific. So for fund managers, we usually recommend them the enterprise. So that's the price you're looking at.
And you do, just to confirm, you do KYC AML on every investor within the fund? Oh, perfect.
Yeah, that's right. Yeah, that's exactly right. Yeah. So yeah, the mechanics of starting a fund on CFP is very easy. It takes like 5 minutes. Yeah, maybe 3 minutes actually. Yeah.
So before we start, it's fair to say we need to have everything lined up, meaning the attorney, the CPA, the docs need to be ready. It sounds like the setting up the fund in the portal is really the last step.
You could say that, or some people actually do it this way, which is if you don't have all the documents, you can actually set it to open to soft commitment. And so people will like commit the fund. And some people actually do like, they raising 1 million, they're paying like 199 trivial. And then they literally pay it for a month just to see how much interest they get. And if they don't get anything, they're not moving forward with the attorney.
Okay, got it.
Yeah. And that's the trick. Yeah.
Got it. Okay.
So you open it up for soft commitment to see how many people even bite. And if nobody bites, then you're like, okay, I don't think I can set out a fund here. It's one of the hard parts about the fund is that it's more difficult to raise money. And then you might say, why is it more difficult to raise money? A syndication, the subject of the money is the property. And so as an LP, I can taste the property, I can look at it, I can drive by it. The subject of a fund is another fund. You have this layer of abstraction that I don't even know what's going on anymore as an LP. That's why it's harder to raise money. Yeah.
Thank you.
Yeah, great. I think that's it. Thank you so much, everyone. And have a great rest of your week. Thanks for coming.